Nathaniel, thanks for joining us on the podcast today. I appreciate you making the time.
Thank you, Jeff. I'm glad to be here, and thanks for inviting me to join you all today.
Absolutely. I'm excited to have the conversation. I think one of the most common themes in my guests is kind of this digital transformation. And, when we were talking in advance, you used the phrase balance of bricks and clicks. And so I really wanted to dive into how you see digital transformation playing out in the context of your institution. I think it's a really interesting concept. How do you balance the non-digital with the digital?
Yeah, so that's an excellent question, Jeff. And I think the consumer in the marketplace now is very used to, they want to be able to choose how they do business with companies. And so I think what we've seen is most consumers start digital. They are in the App Store downloading an app, they're on the website. And then just like with Amazon, you download the app, you set up an account. I saw the same thing I opened a Robinhood account recently just for the fun of it to see how it would go. Yes, and I just couldn't believe how easy it was to set up an account. So I think what I'm seeing is a lot of consumers like to start doing business digital. But in terms of the balance of bricks and clicks is, I think there's a point where consumers run into some trouble, or the online version, they want some extra consultation, or just they have some extra questions that can't be answered online. And at that point, they want to be able to call someone. Or they may want to walk into a physical location as well. So I think all businesses are trying to figure out what is that balance. There are businesses that are going 100% online, full digital. And I think there are businesses, but I think most businesses that have stores also have an e-commerce segment of their business.
How do you think about what the things people want to do in branch, and how you set up either the call center or the branch to serve those needs? Because it feels like it's not just the balance between how much of each do I have, like how many branches to customers, but like what are the activities that I'm expecting people to do in a digital self-directed way versus a time that they want to interact and have a discussion with people, which is maybe different than it was before digital was so widely adopted. What we're going to do in that branch, on that call center, it feels like it's changing. And I'm curious if you have a perspective of where it's headed.
Yes, and another excellent question. So I think a lot of the transactions that happen online are truly transactional in nature. And what happens on the phone or in a branch is more relational in nature. So when people call in or they talk to someone in our branch, they truly want advice. So for example, when people used to come into a credit union branch, they would come in, cash a check, withdraw cash, very transactional in nature. Now you can do all of that online, and most of the time when people come in now, they truly want some advice. So an example I'll share with you is all our branch employees are being trained to become certified financial coaches, because we believe when people come in, they truly want advice, not did I balance? So our employees, their skill set needs to move from cashing checks, balancing their drawers, to truly being able to coach a member on how to create a budget, how to start saving for retirement, those type of things. So transactional, online, relational, in person.
I love that. I love that you're having them all certified financial coaches. I think that's such an interesting path to actually have the branch employees up leveling their capabilities. And it probably switches what you think of as the priority for digital. I remember the gold rush around AI, and like all your advice and conversation was going to go digital. And it feels like you're saying it's more the transaction that goes digital. And that advice actually is the thing we want to bring back and make sure we're delivering on in the in-person, the human touch experiences.
Absolutely. You nailed it, Jeff. Everything, I think anything that can be easily done, they want to be able to do that with a few clicks. And but more complicated decisions that are more impactful to their life, I think most consumers want to sit down and talk to someone.
Want to have a conversation. And how have your employees reacted to that, being requested to get certified as financial coaches? Like how do the branch employees feel about that shift in kind of what they're doing and the expectations and responsibilities that are being placed on them?
Yeah, so that's a good question, and it's been difficult because there was a segment of our employees that they just wanted to do the transactional part, and so I think as we started moving down this path, some of those employees left the organization. The employees that were excited about this, they're this is career growth for them. They get to learn how to be a financial coach, something that they thought they would have to go to school for. But this is different than financial advising. But this is more financial coaching, so basic type of financial advice. But we're starting with branch managers first. So we want to certify all our branch managers and probably supervisors by the end of next year. Then we'll slowly start training the rest of our staff as well. Now, one of the things we're doing is once they become a certified financial coach, they get a pretty good bump in pay. So that's been a nice incentive for them.
It's a good incentive.
Exactly.
Yeah, my experience talking to others in this space is that a lot of employees enjoy this because they're moving away from administrative, more kind of rote work into more thought-provoking and higher value add. Customers are, it's a higher level of kind of service that you're providing, and customers like it. So I tend to see that most employees go, hey, this is like, I feel like I'm doing more. Customers are appreciative more for what I'm providing, and it's a nice opportunity for them. So it's really cool. I need to figure out what a certified financial coach. I need one of those too.
Yeah, we partner with a company called TCG here in Austin, and they're a financial advising company, and they created a program just to certify our employees. So we're really excited about that, and yeah.
Very cool. Well, I want to switch gears a little bit to kind of the consumer lending space, and I think there were two topics in lending that I wanted to discuss. One was kind of the mechanisms by which we determine to whom to lend and how much and what kind of products, and your thoughts on if there are shifts or challenges in the way we've traditionally approached the assessment of, who should qualify, who shouldn't qualify for different kinds of loans.
Yeah, so consumer lending it has changed significantly, especially in the last couple of years. It used to be traditionally, you just look at a credit score, you're looking at collateral. If there's not collateral, then you're increasing your rate. So that's a very traditional way of consumer lending. And many times what's going on in the marketplace is people that should get approved for loans probably aren't getting approved. And then people that we think are that should get approved, that aren't getting approved, should get approved. So I think I said that correctly. So
well, it's both sides, right? There's people that are denied that were good borrowers, but then there's obviously people that are, all losses are people we probably shouldn't have lent to, and that's both bad for the institution, but also I always think it's bad for that person. Like it's if I give you a loan you can't repay, I haven't helped you, I've hurt you, as well as obviously losing money for the institution.
Yeah, exactly. In fact, Jeff, during the 2008 through 10 financial crisis, the highest bucket of losses in lending were in A and A plus. So that's a good example where, someone with an A plus credit score, they may have a good credit score, but it doesn't mean that they're financially savvy with their money. And then someone that has a poor credit score maybe is more financially savvy, but ran into a couple struggles in life, hit some bumps in the road, but they're someone that would pay back. So I think the credit score, is a very outdated way of approving consumers, and I think it is moving more towards artificial intelligence and getting all the information you need, really understanding the story. Even in credit scores, there's someone that has a poor credit score but is improving. There could be someone with a good credit score but they're on the decline. And unless you understand the story and being able to pull all those factors in, and traditionally it's been, Jeff, sitting in a branch, talking to a consumer, talking to a family, trying to figure all this out. With all the information that's out there on the internet, I think you can almost do that digitally, take all that information, use artificial intelligence. You may still need to have an interview, but I think there's so much available information now that you can take that and find the story.
It's a fascinating statement about the data and the ability to process it. But how do you as a credit union think about how you actually execute on that? Because AI, we're in that space, and it's a hard space. Is that an area where you look kind of like credit scores? They're fascinating, but on some level I go, you've really outsourced credit decisioning to whoever's making the score at some point when you're using a credit score that you don't, that's not really internal to the institution. How do you think about how you develop decisioning capabilities, whether it's the technical side or the human side, as an institution that's probably not going to be on the cutting edge of artificial intelligence research and capabilities?
Right.
I'm fascinated by how you think about actually building up the capacity to do that.
Yeah, so Jeff, I think there is a difference in how large banks like Chase, Bank of America go about doing this versus community banks and credit unions like us. So we're $1.2 billion credit union in San Antonio. It would be very difficult for us to develop the capacity internally to hire all the employees needed to figure this out and then to build a system. So for us, a lot of what I think community organizations like us need to do is go out into the marketplace and figure out who to partner with, because there are outstanding organizations, and we've decided to partner with Upstart. But there's a lot of organizations out there that are trying to figure this out. And I think it's just, sitting down, doing the homework, the research, finding out who's best out there, who's moving down this path, and partnering with them and seeing if you can figure this out together.
Yeah, I think that's probably right for most institutions. And I'll tell you, I'll tell this to Chase and Citi and B of A, but I'm still somewhat skeptical that even they are going to be best in class at building some of these things in-house, because I think it's a different skill set and environment. I did want to, your topic about partnering and finding the best provider wanted me to bring up another conversation, which is kind of this idea of how many of those partnerships do you want, and really kind of how broad of a product portfolio do you feel like it's important for you to deliver on for consumers today? And has that shifted in terms of, I think we used to think of like the bank was, my credit union was everything. I was going to get every product from one place and one branch as the kind of precursor to the app, if you will. Is that still the model, or do you think that that's shifting as you move into these partnerships? Are you looking at kind of fewer and more focused, or are you looking at kind of holistic across the board? How do you think about that kind of breadth of product offering and how it plays into your partnerships and what you deliver to consumers?
Yeah, so Jeff, I think that, if you rewind back 10 years, 15 years ago, I think every organization wanted to offer everything to every consumer. And in the banking industry, it's, we want to offer consumer lending, we want to offer mortgage, business, insurance. And with all the fintechs that have come in, I think it's become more specialized. You have companies like Lemonade, for example, that focus just on insurance, and they're outstanding at it. And I think I just look in the marketplace, and I think Jeff and you and I were talking about this earlier. It used to be that 20 years ago, I went and ate at McDonald's for everything. Whether I wanted a chicken sandwich, whether I wanted coffee, whether I wanted a hamburger, I went to McDonald's for everything. Now, if I want a chicken sandwich, I go to Chick-fil-A. If I want coffee, I go to Starbucks. I may go to McDonald's if I'm craving a Big Mac, but it would be just for the Big Mac. But there's so many burger places like In-N-Out Burger. So I think I use that because I'm seeing this pattern in the marketplace that there are companies coming out and saying, we're going to be the best in the world at this one thing. And so I think as those things start happening, it gets very difficult, in my opinion, to have an organization that serves all these products and services really well, because the consumer expects excellence, right? If you go to Chick-fil-A, you expect the best chicken sandwich in the world. So the more products you sell, unless you have infinite resources, which most organizations don't, you become average at a lot of different things, and the consumer isn't going to be okay with it. So you have to pick and choose where you think you can excel, what consumer you're going after, what are 2-3 products you feel like you can win in the market, and you have to go win there.
Yeah, it's a great example. And you compare McDonald's to In-N-Out. In-N-Out doesn't sell a chicken sandwich. You want a chicken sandwich, you go to In-N-Out. Say, I like a chicken sandwich. They go, gonna have to go somewhere else, big guy. We do burgers. We do them really well. But that's you can have the meatless burger, which I don't quite understand. But it's just one thing, and they do it well. Yeah. I'm curious. There is an approach to having a broader breadth of products that are first in class for an organization like yours. That's partner with a fintech or a technology player that's, as opposed to having one partnership that does 30 things. Maybe I get 5 or 6, and they're each best in class. Do you think that you're moving towards a world where you have a relatively wide breadth, but you're kind of partnering to get the best in class experiences for each? Or do you think the capacity of the organization is, hey, we're going to pick a couple, and whether we're building in-house or we're delivering through partnerships, we're going to focus on the couple things we think we can really do top notch.
Yeah, I think it's the latter, Jeff. It's picking out a few things, and I think that's the balance, right? That is, it's more art than science. And because if you spread out, if you try to do too much, you spread your resources too thin. If you do too little, you may not be able to you may not be serving the needs of the marketplace. So I think it's really understanding the needs of the marketplace, and I think you probably need to win in a few areas. You start with one area that you're better or different than most organizations, and then you have a few complementary products and services to that. I also think there's there's certain table stakes in every business. So like in banking, people expect to move money easily. They expect that you probably have a credit card, a personal loan, consumer loan, mortgage. They expect that you probably have those few services. Business lending, they may be okay if you don't offer that. But I think there's some art to having the right balance of that, I think.
No, I agree 100%. We see the same thing in technology companies, which is a lot of startups feel the need to be too many things too quickly, and they end up being meh at each, and they can't win that way. And usually the winners are focused on a singular area to a degree where you go, how are you this old of a company and this big, and you only do like this one little thing? And there's this kind of real art to being able to focus on what it is you can really be best in the world at and deliver on, and not getting distracted by all the nearby stuff we could do, but like, can you do it well enough to be better than the person who's only focused on that thing? That's the challenge, I think.
Yeah, and you have to have a few areas that you want to win, because what if one area doesn't work the way you expect? So one of the factors that led us to Upstart is Upstart does AI for personal loans. But we also knew that it was on the roadmap to go to vehicle loans, and then possibly mortgages. I think I heard your CEO talk on a podcast. And so when I talked to our team, I was like, okay, they have a path. Because I think when you think about artificial intelligence and lending, we need it in personal loans, auto loans, and mortgage. And so I think, you do have to have a certain breadth of products and services, so that if one area doesn't go the way you expect, your business isn't solely dependent. Solely dependent on that one piece.
Yeah, we are headed in that direction, but I think we're probably an example of maniacal focus. I mean, we've just started expanding to new product lines in the last year, and it's been a long ride, but we feel like that gave us the foundation to say, hey, we've got a pretty good core. We know what we're doing. It's now time to expand. But I think many of our peers went to 4, 5, 6 products within 2 or 3 years, and we kind of said, no, we're gonna get this one right. We're gonna learn a lot from it, and then it's a question of like, okay, now where else do I go? Because those technologies are certainly applicable other places.
Right.
Go ahead.
No, I was going to share. There's a concept that I heard Kathy Wood talk about. She runs the ARC funds, and she talks about an S curve. And so every product goes up this S curve, and there's a point that a product matures, and you need to have the next product available. I think this happens with the iPhone 1, 2, 3, 4, 5, right, all the way to 13 now, right? Each of those has an S curve. And I think what Upstart is doing is really smart, because as you're moving up that S curve, you want to get enough momentum before you're working on your next thing. And if you do it too early, then you're hurting the current product and the current momentum as well. So that S curve and how you go there, again, more art than science to that, I believe, and a lot of executive judgment, and really knowing the marketplace and knowing the capability and capacity of your team.
Yeah, I agree with the more art than science, because it certainly is a topic that we spend a lot of time agonizing over. Are we hurting ourselves by not being in more areas more quickly? Are we detracting from the growth of the core product that's succeeding by being too aggressive in other areas? And like, you're probably kind of like, I always describe my ideal job as like one where you feel kind of capable but not quite ready. And when you're not quite sure if you're too far one way or the other, you feel like you're kind of teeter-tottering. That's probably somewhere close to the right edge in this kind of decision. But it's tough, because every quarter we have to have that debate about how much are we investing in new stuff versus improving in the core. And it is not, I wish there was like a clean cut, here's the Excel formula, put in these 10 pieces of information and you'll have the right decision. But it's it's a lot of judgment and discussion and a lot of, frankly, questioning of your call at the end of the day going,
Yeah.
if we do that one right, I don't know. Because
Yeah.
there's no clear-cut answer.
Yeah, if success was easy, everyone would do it.
That's
There's a
right.
reason there's so few companies that can go figure this out. I think there's several thousand fintechs out there, but you can see the maybe 20, 30 that are starting to rise to the top, and it's not easy. Everyone is trying,
No.
but and again, I think the ones that make it have outstanding leadership teams. That's something I've noticed too. With all these fintechs, I really like to understand who's the CEO, what's the leadership team, what's the plan look like, because that leadership team I've noticed is separating the cream of the crop from the others.
Yeah, it's probably with so much judgment involved in how you do these things. You got to have sound, and sometimes I think the fortitude to stay the course when the market or investors or the press feels like, hey, you should be doing more quickly. And you go, no, we're going to stick to our knitting and do the core, or whatever that kind of debate is. It takes a little bit of self-confidence and probably experience to be able to
I agree.
kind of, to stick to your guns and make the call you think is right.
Absolutely, Jeff.
So one other area I want to talk about that you had mentioned was this kind of, maybe I'll call it a shift in distribution, or how consumers interact with where they expect to get loans and interact with that experience. So can you talk a little bit about, it used to be, I think people came to the branch and said, hey, how can I get a loan? What can I qualify for? And I think you see a shift in that I'd like to explore a little bit.
Yes, significant shift. Many years ago, a consumer wants to buy a car. They would go to their local credit union, their bank, and say, how much can I afford? I want to get pre-approved for a loan. And then they would go look for their car. All that has changed completely. And now, when you want to go buy a car, it's almost every single time you're starting on Auto Trader or you're going online, you're looking at cars. You go find the car you want, and then you go to the finance office, and they're telling you your options. So the financing for vehicles has gone to point of sale. I'm seeing that trend has now moved almost to every other segment as well. You want to go buy some furniture, you go buy furniture, and then there's a buy now, pay later option. You're seeing buy now, pay later options. I think Affirm started with Peloton. Now they've moved everywhere. I think Square bought a buy now, pay later option. So
right.
I think financing is starting to move to point of sale, which is the consumer starts shopping first before they even think about needing to finance it. They say, I need a car, I need furniture, or I need this. They go start shopping. And then as they're shopping, then they start thinking about financing. So I think financing options are also starting to be embedded in point of sale, especially the more things go digital. And so there is that big shift, and I think it's also happening in the mortgage world. It's a little different. I think that is such a big purchase that people do tend to think about financing around the same time they're thinking, I'd like to buy a house. How much money do I need? They may consult someone first before buying a house, but definitely on the smaller purchases, they're thinking about that financing or that option at point of sale.
Yeah, they're thinking about it after they figured out what they want. What do you as a credit union do in response to that shift? I mean, people aren't coming to you now for a loan in advance. They're going to the merchant, going to the car dealership, maybe going to Redfin or Zillow to find a house that's in the area versus coming to the CU to say, hey, what could I qualify for? How do you react to that as a credit union? What do you do?
Yeah, so this has been a big challenge, and we've had a lot of intense conversations about this, especially as buy now, pay later took off, because this is going to affect how people use their debit and credit cards. Maybe they were going to plan on as they were going to check out, they were like, okay, I'm going to use my credit card on this, and then they go check out and they see, oh, I can do a buy now, pay later through PayPal or through Affirm or through Square, whatever that may be. So a couple things our team has done. We've been dealing with this on the vehicle lending side for a long time. So we have great relationships with the dealers, and I think that's been in the marketplace for a long time. On the personal loan side, or someone goes and buys smaller purchases, what we are thinking about doing is offering 0% for 6 months on all purchases all the time. So that is so on every purchase you make, from the time you purchase it, you have 6 months of no interest. Because we're trying to figure out how do you combat buy now, pay later. So someone has a credit or credit card in their hand from Firstmark Credit Union, and they go to check out and they're enticed with Affirm or PayPal. And we need to have a product. Now, we are clients of PSCU as well, which is a payments company that serves about 1,500 credit unions in the United States. And we've had a lot of conversations about this as well, about should PSCU help credit unions to embed a buy now, pay later option very similar to Affirm. But I think our way to combat that is to 0% for 6 months on purchases all the time. The other thing I'm not sure about, Jeff, is buy now, pay later a fad? Are people going to default more as time goes on? I know there's been, from what I've read, there's been already significant amount of defaults, but I think it's not because people can't pay. They don't know how to pay. It's kind of confusing. They may have buy now, pay later through Affirm on one site, then through another company on another site, and they're just like losing track of who to pay. And so, and buy now, pay later as well. It's an Amazon, but obviously it doesn't make sense to do buy now, pay later, maybe on $100 purchase. Maybe if you go do $1,000.
Yeah, I saw it on a pizza delivery, and I went, I don't know if you need to be splitting up your pizza delivery into four. Like, maybe just wait till you get the money to buy the pizza. It seems a little excessive to have buy now, pay later on my Domino's or whatever.
Yeah, so these are the things that I'm not sure about, and I also think that a lot of the buy now, pay later financing options don't show up on your credit report. So you may not be sure the debt you're incurring as well. So this is the piece that I'm really unsure about. I'm unsure about buy now, pay later, if it's a fad or if it's really going to stick. I'm not sure yet.
It'll be interesting. The other thing, I'm not sure if you've explored this yet, but how a lot of those companies finance their 0%, right, is by above traditional even credit card fees from the merchant, right? The credit card is usually 2.5% to 3%, debit card, much lower. And then some of these firms are making 5-6%. And I guess the commerce companies, the merchants, are doing that for increased pull-through rate, increased cart size, right? They're able to increase their transaction sizes, increase their conversion rate, which feels like something, it will be hard, I would think, for you to compete economically with a 0% unless you can also access some of the economics that the merchants are willing to pay because they're making more sales on that. So I'm curious, have you explored with your payments company or somebody else the idea of like, hey, we can do this on a credit card with 0% for 6 months or whatever, but to finance that, we really need to be getting at least some version of the economics that the buy now, pay later companies are getting from the merchants that are funding that. Like, you can't give money away for free. Money has a cost, right? So to put 0% interest, you got to have the revenue. And that feels like the piece to me that's got to get connected before you've got different payment options that really make sense.
That's right. And every time someone uses our credit card, Jeff, they go swipe our card, we get a few percent interchange income. It's called interchange income. We get it from Visa. So for us, we're foregoing the interest to get swipes.
The interchange.
And you're exactly right. And the other thing, too, is I think that most consumers don't pay off their bills within 6 months. So at that point, it may be 0% interest for 6 months, but there are purchases at some point that they'll end up paying 10% for. Let's say that's the rate on our card. But I think for us, it's kind of a lesser of two evils. With buy now, pay later, you don't want people to stop using your card because every time someone swipes our card, we make income. And if they're using our debit card, we're making income, and it's coming from a checking account, which is that glue. That's the core account of our organization and of our consumer relationship. So for us, it is making some very difficult changes. Banking is just changing so much, Jeff, and I'll tell you, it's a scary and an exciting time to be in banking because it's being completely disrupted.
Yeah, I guess it's an exciting time if you like the disruption, and if you want things to stay the same, well, this isn't the space for you.
Yes, and it is. Again, candidly speaking, I've told this to our team. It's scary, and I think Jamie Dimon said the same thing, that we should all be scared. And he used a different choice of words about fintechs because they are chipping away at our business, and we are having to transform. And I think a lot of organizations won't be in business 5, 10 years from now. But I think there's the organizations that are transforming. I think they'll have a good shot.
I think that's right. I think the same is true of fintechs, frankly. Like, I mean, to your point, there are thousands of fintechs, and if I had to make a guess in 10 years, will those still be thousands? Like, no, there'll be those who are actually adding value to consumers and actually figuring out how to provide valuable products, and there'll be those who don't. And I think the same is true of credit unions and banks. It's like some will adapt and actually continue adding value in the way consumers want in the modern world, and they'll thrive. And frankly, I think it's an exciting opportunity for an organization like yours because you have the ability to punch above your weight class in some ways, whereas before there was a real capital restriction to growth in terms of like branches and physical footprint, and it was limiting. And in a digital world, there are ways to grow and kind of play in a larger space without as much capital intensive if you can really provide the right experiences. So I think it's an exciting time for the organizations that are ready for that challenge, but it's a very different model, and what will drive winners and losers is not what it used to be.
I agree, Jeff. I agree. And it's going to be a fine balance of that digital and that interactional, that relationship aspect of the business, because you're exactly right. You can almost punch in a higher class, and at the same time, we'll never outspend what Chase is going to spend on digital. Yeah. And so I think it's figuring out, okay, we can now offer a lot of the same digital tools. We can partner with fintechs. And then how at the same time do we keep community relationships? How do we continue to do good and have boots on the ground and give back to the community so the community still sees the difference, that we're still a community partner? And I think finding that balance is also very important.
Yeah, and probably kind of like the sticking to one thing or doing multiple. It's as much art as it is science.
Absolutely.
Maybe the team might name the podcast that, as much art as science. Well, was there anything you wanted to talk about or expected to cover that we didn't get to today?
Well, just one thing, Jeff, and I was thinking about this whole notion of as you go more and more digital, how do you keep loyalty to your members and
think about that a lot.
Customers? And I noticed Lemonade doing this too. A part of the fees that they're charging goes back to donations, to giving back to the community, right? To doing good. It's a philanthropic arm. And I've noticed that as well, that consumers want to do business with organizations that are going to make the world a better place. And it was something that's really interesting is we created a new account. It's called Power the Dollar. And it's a checking account, and there's the Power of the Dollar, which is $1 service. We call it an impact fee a month. The other one is $3 a month, $1 going to and $1 goes to our foundation, and then that foundation gives back to the community and does projects in the community. It helps school, it builds gyms, it sends kids to college, it does all these things. So, I think this notion of also doing good and making the world a better place is something that's very important to also, in addition to, as you go digital, yes, you have to have the right balance of bricks and clicks. I also think it's also important to have an aspect of your business that's making the world a better place.
No, I agree. Consumers are increasingly voting with their dollars in terms of working with organizations that they feel like we see this so much in the techlash, and the move away from some of the big brands to say, hey, I want to work with local businesses that are supporting local jobs, or companies that share my values and are trying to make the world a better place through their business models. I always think I love foundations for businesses, but I also sometimes look at companies that go, your core business isn't set up to do good for the world, and then you're kind of like paying your penance with some donations. And I think it's important to have both, right? Really giving back, but setting your business up so that you're succeeding when your customers are succeeding. Right, you're succeeding when you're making your community better, and not making those two things in opposition. Because ultimately, we live in a capitalist society. So if the business models are set up so that you can succeed when you're making the world a better place, and then you can contribute as well, I think that's the most powerful combination you can get. And consumers are drawn to that.
That's an excellent point, Jeff. Yes, your business needs to align about making the world a better place, not just your philanthropic arm. That's an excellent point.
That's right. You can't be extractive and then go, I'll go pay my penance and put some dollars, but forgive me for my sins. It's important to get both.
Yep, absolutely.
That's a good closing thought. So I have 3 questions I always end the podcast with, Daniel. So I'm going to throw them out there for you now. You're probably ready for these.
Okay.
What's the best piece of career advice you've ever gotten?
Best piece of advice I've ever received is it's okay to fail. Own up to it, learn from it, don't make the same mistake twice. In terms of failures as well, don't make catastrophic failures in life that you can't recover from.
Just don't make the catastrophic ones. The rest of them are okay, but the big ones are
Yes.
avoid. All right. It's okay to fail. What's the best piece of advice you've gotten about, consumer finance or consumer lending?
Understand a person's story.
Understand a person's story.
Yeah, well, understand what is their story. And rather than just looking at a credit score or collateral, understand a person's story, where they're at in their life, and how you can help them. And you may have to tell them no now, but give them hope. Tell them, here's the plan. Here's how we're gonna follow up in 6 months, and we're going to get you the car you want, the credit card you want. Here's the path. And so it's about understanding a person's story and giving people a plan and give people hope.
Help them write the next chapter of that story.
Exactly.
Sounds like you went through your certified financial coaching training yourself.
Not yet, but it's coming.
It's coming. You got to get on that. It sounds pretty good. And then my last question, what's a bold prediction? We've had a couple of relatively bold predictions, but what's a bold prediction for the future?
I think credit scoring is dead in terms of consumer lending specifically. I think 5 to 10 years, I'd say 10 years from now, we'll have half the credit unions and banks in the country that will still be in business. I think there's about 5,000 banks in the country, 5,000 credit unions. I'm rounding
right.
here. And so let's say 10,000 financial institutions. I bet there'll be half in 10 years.
All right, half the financial institutions continue. That is a bold prediction. I was shocked to find out how many there were, frankly, coming from tech. And then I was shocked to look back and go, in 1970, how many were there? And
right.
Oh, it was a lot more. I mean, 10,000 sounds like a lot, but there were 20 or 30,000 financial institutions back then. I think that trend line, you're probably not a crazy prediction that one's going to continue.
Exactly.
Well, Nathaniel, I've enjoyed this conversation a lot. I really appreciate you making the time, and have a great rest of your day.
Thank you, Jeff. You take care. See you soon.
All right. Thanks.
Bye.